Okay. Okay. So here we go. I'm going to be reading from this. See how fast I'll get through this document. Speed reading. Financial bubbles and institutional legitimacy. Structural similarities, confidence systems, and collapse dynamics. Introduction. Financial bubbles and crises of institutional legitimacy are often treated as unrelated phenomena. One belongs to economics and capital markets, the other belongs to governance, politics, public administration, law, education, regulation, and social trust. However, structurally, they frequently display remarkably similar patterns. Systems, what happened there? 1, 2. Can anybody give me? Let me start again. 1, 2, 1, 2, 1, 2. Okay. Financial bubbles and institutional legitimacy, structural similarity, confidence systems, and collapse dynamics. Introduction. Financial bubbles and crises of international legitimacy are often treated as unrelated phenomena. One belongs to economics and capital markets. The other belongs to governance, politics, public administration, law, education, regulation, and social trust. However, structurally, they frequently display remarkably similar patterns. Both systems can become dependent upon confidence. Actually, I should mute this sound. I can't mute this sound. Okay. However, structurally, they frequently display remarkably similar patterns. Both systems can become dependent upon confidence, narrative enforcement, symbolic signals, selective disclosure, deferred scrutiny, and collective belief in stability. In both cases, instability may emerge when underlying fundamentals diverge from public perception, accountability mechanisms weaken, and confidence begins to fail faster than the institution can restore stability. Comparison is not literal equivalence. A stock market bubble and a legitimacy crisis are not the same thing, but they are often governed by comparable feedback dynamics. The central structural similarity is this: perceived stability leads to confidence, which leads to participation, which leads to reinforcement, which leads to greater perceived stability. When the cycle reverses, loss of confidence leads to scrutiny, which leads to exposure, which leads to further loss of confidence. This paper examines the structure of financial bubbles, the nature of institutional legitimacy, and the ways systems can drift into confidence dependent fragility. One, what is a financial bubble? A financial bubble occurs when asset prices become disconnected from underlying economic fundamentals and continue rising primarily because participants believe prices will continue rising. Classic examples include the South Sea bubble, the Mississippi bubble, tulip mania, the dot-com bubble, and the 2008 housing crisis. A bubble generally contains several components: the bubble component and its description, a narrative, a compelling story explaining why prices should rise, expansion, increasing participation and capital inflow, reinforcement, rising prices validate the narrative. Further bubble component descriptive. Social proof, others appear to profit, encouraging more entrants. Suppression of skepticism, critics are dismissed or as irrational or outdated. Structural fragility, the system depends on continued confidence. Trigger event, confidence weakens. Collapse, repricing occurs rapidly. The South Sea bubble is one of the clearest examples. The South Sea Company was created partly to absorb British government debt while presenting investors with a narrative of imperial trade opportunity. The mechanism depends heavily upon political endorsement, investor confidence, speculation, and continued expansion. Once confidence weakened, collapse followed rapidly. What is institutional legitimacy? Institutional legitimacy refers to the degree to which, one, the public, stakeholders, courts, regulators, staff, or affected communities believe an institution is lawful, competent, ethical, effective, fair, and trustworthy. Examples include legitimacy associated with governments, universities, courts, regulators, police, corporations, healthcare systems, charities, and international organizations. Legitimacy is partly evidence-based, but it also is partly confidence-based. Institutions do not operate solely through the force of legal authority. They also operate through public belief that procedures are functioning, safeguards exist, accountability mechanisms work, and outcomes are generally fair. Without legitimacy, institutions become unstable. The structural similarity. The structural similarity between financial bubbles and institutional legitimacy crisis lies in the relationship between 1. Appearance, 2. Confidence, 3. Underlying reality, and underlying reality. Next page. Financial markets. In a financial bubble, rising prices generate confidence. Confidence attracts participation. Participation pushes prices higher. Higher prices appear to validate the system. The process becomes self-reinforcing. The system increases its dependence not on fundamentals, but on the continued belief in the system itself. Institutions. In institutional legitimacy systems, 1. Positive public narratives create trust. Trust reduces scrutiny. Reduced scrutiny allows unresolved weaknesses to persist. Symbolic compliance reinforces public confidence. Confidence itself becomes evidence of legitimacy. Again, the process becomes self-reinforcing. Symbolic compliance and performative stability. One of the most important concepts in institutional analysis is the distinction between formal compliance and operational effectiveness. An institution may publish policies, conduct training, create diversity statements, establish ethics committees, appoint oversight officers, and produce annual reports. Whilst lacking measurable outcomes, independent verification, operational safeguards, or effective corrective systems. This creates a condition sometimes described as performative compliance, symbolic legitimacy, or institutional decoupling. The institution appears compliant externally while internally lacking robust operational evidence. The structural parallel with bubbles emerges when appearance substitutes for verification, narrative substitutes for evidence, and confidence substitutes for measurable performance. Diversity policies as a confidence structure. A diversity framework can become confidence dependent if 1. Policy existence is treated as proof of effectiveness, or metrics are unclear, or adverse outcomes are not independently audited, or complaints are systemically filtered, or institutions rely primarily on reputational signaling. In such systems, legitimacy may derive from branding, public statements, awards, symbolic appointments, or procedural language. rather than demonstrable evidence that discriminatory outcomes are decreasing or safeguards are functioning and accountability systems are effective. This does not automatically imply bad faith. Often institutions sincerely believe they are compliant, procedures are adequate, and systems are functioning properly. However, without rigorous verification, the institution may gradually become dependent upon narrative maintenance, reputational protection, and confidence preservation that is structurally similar to a bubble dynamic. Feedback loops. Both financial bubbles and legitimacy systems depend heavily on feedback loops. Financial feedback loop. Rising prices leads to investor confidence, which leads to more buying, which leads to further price increases. Institutional feedback loop. Positive public narrative leads to institutional trust, which leads to reduced scrutiny, which leads to continued narrative dominance. These loops can continue for long periods of time. The longer they continue without serious verification, the greater the potential divergence between perception and underlying operational reality. The role of metrics. Bubbles often involve distorted metrics. Examples: price to earnings ratios ignored, debt hidden through financial engineering, or inflated valuations justified through narrative. Similarly, institutions can rely on selective reporting, incomplete equality statistics, procedural counts instead of outcome analysis, superficial compliance indicators, or internally controlled audit systems. A key warning sign in both domains is metrics that demonstrate activity rather than effectiveness. For example, a number of diversity trainings, number of policies issued, number of committees formed may say little about fairness, discrimination reduction, procedural equality, or operational safeguards. Deferred scrutiny. Both bubbles and institutional legitimacy systems often survive because scrutiny is delayed. Reasons include political convenience, or social conformity, or reputational fear, or complexity, or information asymmetry, or dependence upon the institution itself. In bubble environments, skeptics are dismissed as irrational. Critics are accused of misunderstanding innovation, and warnings are ignored during expansion phases. In institutional settings, complainants may be characterized as isolated, or insane, or mentally ill, or concerns may be proceduralized. or disclosures delayed, disclosures delayed, or criticism reframed as misunderstanding policy. This does not necessarily require conspiracy. Complex systems naturally develop incentives towards self-preservation, narrative protection, and reputational continuity. Triggering events, financial bubbles usually collapse after liquidity shortages, rising rates, leverage failures, or sudden recognition that expected returns are unrealistic. Institutional legitimacy crises usually emerge after whistleblower disclosures, tribunal findings, leaked communications, statistical evidence, investigative journalism, litigation, regulatory intervention, or accumulative public distrust. The triggering event often matters less than the pre-existing fragility. The collapse occurs because confidence was already structurally vulnerable. Collapse dynamics. Financial collapses are often rapid. Institutional legitimacy collapses are usually slower and more uneven. However, once legitimacy deteriorates, public trust declines, compliance weakens, scrutiny intensifies, internal contradictions become visible, and reputational repair becomes increasingly difficult. Examples historically include policing scandals, church abuse crises, and regulatory failures, university governance controversies, corporate ethics failures, and governmental corruption inquiries. Important differences. The analogy has limits. Financial bubbles Financial bubbles are numerically measurable, market priced, liquidity sensitive, and capable of immediate collapse. Institutional legitimacy Institutional legitimacy is social, political, psychological, and currently and uh, mediated. Culturally mediated. Institutions can survive long periods despite declining trust, contradictory evidence, or operational dysfunction. Governments especially possess legal authority, coercive powers, taxation powers, and institutional inertia. Therefore, legitimacy crises are often prolonged, contested, and partially managed rather than fully collapsing. Confidence versus verification. The central lesson from both domains is the distinction between confidence based stability and evidence-based stability. Confidence-based stability depends on belief. Evidence-based stability depends on verification. Confidence-based stability is narrative-driven. Evidence-based stability is audit-driven. Confidence-based stability is symbolic assurance. Evidence-based stability is measurable outcome. Confidence-based stability is reputation-centered. Evidence-based stability is evidence-centered. Confidence-based stability is fragile under scrutiny. Evidence-based stability is more resilient under scrutiny. The more a system depends on confidence alone, the more vulnerable it is or it becomes when scrutiny intensifies. The governance implication. The solution to bubble-like legitimacy risk is not cynicism. It is verification. Stable institutions require transparent evidence, independent oversight, measurable outcomes, operational safeguards, correction mechanisms, and meaningful accountability. Without these mechanisms, systems may gradually drift into confidence dependency, symbolic governance, and reputational fragility. Conclusion. Financial bubbles and institutional legitimacy crises are not identical phenomena. However, they often share deep structural similarities. Confidence reinforcement, narrative dependence, delayed scrutiny, symbolic signaling, and vulnerability to sudden exposure of underlying weaknesses. The most dangerous systems are not necessarily those with visible problems. They are systems where confidence remains high, scrutiny remains weak, and evidence of actual performance is insufficiently examined. The historical lesson of the South Sea bubble is not merely that speculation can collapse. It is that systems dependent upon confidence alone can appear stable long after structural fragility has already developed underneath them. Financial bubbles and institutional legitimacy, asset valuation and taxation, a structural analysis of confidence-based economic systems. Introduction. Modern economic systems are not sustained solely on physical production, labor, or material resources. They are also sustained by confidence, institutional legitimacy, collective expectation, legal enforceability, and perceived stability. Financial bubbles and institutional legitimacy systems are often treated as separate domains, one belonging to economics and markets, the other to governance, law, regulation, and politics. However, both systems influence asset valuation and taxation capacity. Public borrowing, state stability, and the functioning of modern economies. At the deepest structural level, both financial bubbles and institutional legitimacy systems can contribute to environments in which, one, assets become highly valued, confidence sustains participation, rising valuation generate taxable activity, and governments derive operational capacity from those conditions. The key mechanism linking all of these processes is confidence. This document examines 1. How financial bubbles influence taxation, how institutional legitimacy stabilizes asset systems, how states become structurally connected to asset valuation, and how confidence driven systems can become simultaneously productive and fragile. The nature of value in modern economics. Modern economic value is not purely material. A large portion of asset value depends upon expectation, enforceability, institutional trust, and future confidence. For example, a currency note has value because people trust it can be exchanged. A share certificate has value because ownership rights are recognized. A property title has value because courts and governments enforce claims. And sovereign debt has value because investors believe the state will remain operational. Thus, asset systems are partly psychological and institutional. This relationship can be expressed structurally. Institutional stability leads to confidence, which leads to asset valuation. Without confidence, prices collapse, liquidity disappears, participation contracts, and taxation capacity weakens. Financial bubbles and the expansion of asset valuation. A financial bubble occurs when 1. Asset prices rise beyond underlying economic fundamentals. 2. Largely because participants expect further price increases. Examples include the South Sea bubble, the Mississippi bubble, the dot-com bubble, housing bubbles, and speculative equity manias. During bubbles, confidence itself becomes a source of valuation. The process generally follows this pattern. Rising prices leads to investor confidence, which lead to increased participation, which leads to further price increases. The rising valuation creates paper wealth, collateral expansion, borrowing capacity, spending increases, and broader economic activity, even if the underlying valuations are unstable. How bubble valuations become taxable. Though paper wealth may initially be unrealized, bubble environments generate significant taxable activity. A. Capital gains. When inflated assets are sold, governments tax the gains. Examples: stock market profits, cryptocurrency gains, property appreciation, and speculative equity transactions. B. Transaction taxes. Bubble environments increase trading volume. They increase legal transactions. They also increase brokerage activity. They also increase banking activity. It also increases associated fees and the associated fees. These generate VAT, stamp duties, transaction taxes, and corporate taxation. C. Consumption effects. Asset inflation often produces confidence-driven spending. Individuals feeling wealthier may spend more, borrow more, and consume more. This expands VAT receipts, corporate profits, and income tax generation. D. Property inflation. Housing bubbles are especially important because governments often derive substantial revenue from them, from property taxes, stamp duty, development activity, mortgage lending, and construction-related taxation. Thus, bubble conditions can temporarily increase government revenues, employment, and apparent fiscal strength. Institutional legitimacy as a foundation of asset value. Institutional legitimacy stabilizes economic systems by maintaining confidence that ownership rights will be protected, contracts enforced, markets regulated, and disputes resolved. Assets derive value partly because institutions are believed to function. For example, a pension fund depends on trust in financial regulation. A government bonds depend on trust in sovereign continuity. Corporate shares depend on enforceable legal frameworks. And property depends on recognized ownership systems. If legitimacy collapses, asset values can collapse with it. A simplified structural relationship. Institutional institutional legitimacy leads to market trust. Market trust leads to asset stability. Thus, institutional legitimacy indirectly supports asset valuation, economic participation, and taxation capacity. Taxation as a product of confidence systems. Modern taxation systems depend upon productive activity, stable institutions, and confidence in legal economic systems. Taxation becomes difficult when trust collapses, capital flees, contracts become uncertain, and or institutions lose legitimacy. Therefore, taxation is partially confidence driven. Sorry. Therefore, taxation itself is partially confidence dependent. The structural relationship may be expressed as confidence leads to economic participation, which leads to asset valuation, which leads to tax revenue. Governments therefore possess strong structural incentives to preserve institutional stability, market confidence, and functioning asset systems. The state's incentive structure. Because rising asset prices often increase tax revenues, investment, borrowing capacity, pension stability, and political calm, states may become indirectly dependent upon asset appreciation environments. This does not necessarily imply conspiracy or intentional manipulation. However, it creates systemic incentives towards confidence maintenance, stabilizing policies, reputational management, and intervention during crisis. Examples include central bank liquidity programs, bank rescues, market interventions, quantitative easing, and emergency guarantees. Governments often fear not merely recession, but rapid destruction of confidence. Institutional legitimacy and economic continuity. Institutional legitimacy is economically valuable because it reduces uncertainty. Stable institutions encourage investment, lending, long-term planning, and contract formation. Unstable institutions produce capital flight, risk premiums, reduced investment, and weakened taxation. Thus, legitimacy itself becomes economically productive. The relationship can be summarized as legitimacy leads to predictability, which leads to investment, which leads to economic expansion. The fragility problem. The danger emerges when confidence becomes disconnected from underlying reality. This can occur when asset prices exceed productive fundamentals, or debt becomes unsustainable, or institutions rely on symbolic rather than operational legitimacy. Or public narrative substitute for measurable performance. In such systems, stability may continue, valuations may continue rising, taxation may remain strong, and institutions may appear healthy, while structural weaknesses accumulate underneath. This is the core similarity between financial bubbles and legitimacy fragility. Symbolic legitimacy and performative stability. Institutions sometimes maintain legitimacy through branding, public relations, procedural language, symbolic reforms, or selective reporting. This can create systems where confidence remains high whilst operational evidence remains weak. Examples may include diversity frameworks without measurable outcomes, regulatory systems with weak enforcement, compliance systems based on procedural completion rather than effectiveness, or reputational systems dependent on narrative protection. In such cases, institutional legitimacy may become partially confidence dependent. This resembles bubble structures because confidence itself becomes part of the operational support system. Asset inflation and inequality. Confidence-driven asset systems often benefit asset holders disproportionately. Examples: rising house prices benefit property owners, rising equities benefit shareholders, inflation may erode wages faster than asset values rise. This can produce wealth concentration, political tension, legitimacy challenges, and social instability. Thus, asset inflation can strengthen state revenues while simultaneously weakening long-term legitimacy in inequality if inequality intensifies. Inflation as a hidden redistribution mechanism. Inflation plays a central role in confidence-based economic systems. Moderate inflation can reduce real burden of sovereign debt, sustain nominal growth, and support asset prices. However, cash savings lose value. Fixed income populations may suffer, and asset owners may benefit disproportionately. This creates a transfer dynamic. Group and likely inflation impact. So, if the group is asset owners, they are often protected or advantaged. If the group is debtors, real debt burden may decline. If the group is cash savers, purchasing power erodes. If the group is wage earners, often lag behind asset inflation. And thus, inflation can function partly as an indirect redistribution mechanism. Confidence versus fundamentals. Not all confidence-based systems are unsound. Modern economies necessarily depend upon them. No. Modern economies necessarily depend upon trust, institutional continuity, and shared belief structures. Shared belief structures. Currencies themselves are confidence systems. The critical distinction is whether confidence remains connected to productive capacity, institutional competence, legal reliability, and measurable operational reality. When confidence becomes detached from fundamentals, fragility increases. The circular structure of modern states. 13. The circular structure of modern states. At a deeper structural level, modern states operate with a circular relationship. Confidence leads to asset valuation. Confidence leads to asset valuation, which leads to tax revenue, which leads to state capacity, which leads to institutional stability, which leads to confidence. Each element reinforces the others. When functioning properly, this produces stability. It produces, when functioning properly, investment, innovation, and economic growth. When distorted, the system may become dependent upon asset inflation, debt expansion, symbolic legitimacy, or continuous confidence maintenance. At that stage, Fragility increases beneath apparent stability. 14. The central governance question. The central governance question becomes: is confidence supported by measurable operational reality? Or is the system increasingly dependent upon confidence itself to sustain valuation and legitimacy? That distinction determines whether a system is resilient or structurally vulnerable. Conclusion. Financial bubbles and institutional legitimacy systems are structurally connected through confidence, valuation, taxation, and state capacity. Financial bubbles can inflate asset values, increase taxable activity, and temporarily strengthen fiscal conditions. Institutional legitimacy can stabilize markets, protect ownership systems, sustain confidence, and support long-term economic participation. Together, they help sustain modern asset systems, public borrowing, taxation, and governance capacity. However, both systems become dangerous when one, confidence substitutes for verification, narrative replaces operational evidence, or valuation becomes detached from productive fundamentals. The deeper lesson is not that confidence itself is illegitimate. The modern civilization depends on confidence. The real issue is whether confidence remains connected to reality or reality is increasingly recognized around preserving confidence. That's it.